view. Let me get my screen figured out here. Perfect. Our company is called Discover Options. We are the educational arm of Option View Systems International. Option View has been in business since 1983 and primarily involved and focused on the area of high-end options analysis software. And so about 10 years ago, we started our educational arm, Discover Options, and a few years ago, we came out with an advisory called the VXX Trading System. And it's going very well. And today what I want to do is just show you everything about this, show you the philosophy, the returns we've had, and I think you're going to be very pleased with what you're going to learn here today. So let me click this. There we go. Take a look at this equity curve. All right. Now, when we rolled out the set of signals that we're using, and I'm going to explain what those are, we rolled those out in March of last year in 2016. And then through July 24th of this year, take a look at these returns. The equity curve is outstanding. Bottom right corner, you'll see that the return since then is 232%, or an annualized return of 168%. And by the way, we have Jim Graham from our office here in the room. If you have questions, go ahead and type them in the chat area, and Jim is available to answer those. He is our company's COO, and he knows everything about this system and can answer all your questions. But I'm just going to move forward and explain all this because it's quite exciting. So this equity curve has done, shows a extremely, profitable system. There are drawdowns, as you can see, and we're going to talk about those a little bit. But what we're going to do is explain what goes into this, why this works, the indicators, and the philosophy behind this, okay, to get these outstanding returns. Here is the system. It was developed by Len Yates, our company's founder and president. The VXX trading system times the entry and exit for your capital to be placed as either one, you could be long the VXX. All right, that's the iPath S&P 500 VIX short-term futures exchange traded note, or your money could be long the XIV, the Velocity Shares Daily Inverse VIX short-term ETN, or it could be in cash. Now, both of these exchange traded products, as you'll see here, they relate to the VIX. So let's go to a chart and let's just talk about the VIX first. Then we'll come back to the actual trading system itself, okay? So if we go to a bar chart of the SPX, the S&P 500 index, from back in just a slice of time from mid-14 to mid-15, take a look at the lines going on underneath the bar chart itself. You have the red line, that's statistical volatility of the market itself. We're not paying attention to that right now. Take a look at the blue line. That represents the implied volatility of the options that trade on the S&P 500, the SPX cash options. All right, now those options have time premium, and that time premium in those options imply a certain volatility level in the future. And if you'll look carefully, you'll notice how when the market goes up, look what happens to the blue line. It tends to come down. Now focus your eyes on an area where the market went down dramatically. Okay, do you see what happened to the blue line, the implied volatility of the options? It went up. That blue line is measuring the 30-day volatility, which is essentially what the VIX is. Now, the VIX is a measurement of volatility that's been published by the Chicago Board Options Exchange for many years. It's a running 30-day volatility number coming from the option prices themselves. And every day they will publish the open, high, low, and close and the intraday data as well. And you'll notice here that there is an inverse, as we were mentioning, an inverse action between the VIX and the market. Now, why is that? That's because when the market begins to collapse and go down, all right, the portfolio managers out there that are managing billions of dollars in long equity assets, they can't just simply liquidate themselves and get back in the market quickly. They have to employ hedging measures to hedge their long holdings. All right, so what they do is they go into the options market and they purchase put options that then hedge some or even all of their holdings to a certain level. And as they rush in the market to buy those put options, that drives the blue line up. The volatility of the implied by the time premium begins to climb. And then when the market recovers and goes back up, the hedging level subsides, and then that blue line will begin to come down. And so that's the action driving this, the VIX here, is the action of hedging going on the part of institutions who are hedging their long holdings. Now, watch this. The CBOE, Chicago Board Options Exchange, came out with, a few years back, a futures market on the VIX itself. You know how there are futures markets on interest rate items? Okay, you have bonds, treasury notes, etc. Okay, so, and commodities, energies, and wheat, corn. You can have futures markets on pretty much anything. Well, the CBOE rolled out a futures market on the VIX itself. A futures market on the VIX itself. So now, if you are a portfolio manager that's hedging, all right, and you think that the market's going to go down and the VIX is going to go up, you could just go into the VIX futures market and go long VIX futures. In addition to buying puts, you could go long VIX futures to help you efficiently hedge your portfolio. Now, all this is to give you a backdrop on the VIX futures, because this is where we have the action going on those exchange traded notes. Now, that said, let's go back. Okay, let's go back and take a look at those exchange traded products and how they relate to the VXX trading system. If you go long the VXX, and by the way, these can be traded just like stock. You buy the VXX or you buy the XIV just like you would stock. They're appropriate for a 401k, IRA, etc. But if you go long the VXX, your money is going into a fund, so to speak, that is being managed by a manager who is managing it in a portfolio of long VIX futures. Now, when you buy the shares of the VXX, you are personally not trading VIX futures. Okay, I want to make that clear. The VXX trading system does not involve you trading futures of any kind. Your money is in one of these exchange traded products, and it is used to take a position in the VIX futures. Okay, just want to make that clear. So if you're long the VXX, your money is being used and managed in a long VIX futures position. If instead your money is in the XIV, your money is being used and managed in a short VIX futures position. All right, just want to make that clear, because that's kind of what's going on when you go long either of those two. Now, before we get into the philosophy as to why we go back and forth here, I want to just, full disclosure, we have an advisory that we give out trade alerts and signals. And I'm going to show you all this in just a few minutes. You also get our access to all our proprietary indicators and more that you're going to see today through the member section of our website, and also within our Option View software. And also we have end of month status updates as well as to how well the system did for the month. Okay, just want to give you a little preview there. Before we get into the philosophy too, I want you to know that the VXX and the XIV are both very liquid assets. If you get a signal to go long either of these or close out your position in either of these, know that when you go there and you're dealing with liquid assets, the VXX averages over 80 million shares traded per day. XIV averages over 30 million shares traded per day. Very liquid exchange traded products that we're talking about here today. All right, here is the heartbeat of the VXX trading system. It's called the Yates VXX Indicator, or the YVI for short. It is a 15-day simple moving average of a component I'm going to explain very clearly here in just a minute. All right, and that component is something we have to really talk about, but take a look at this. What this does is, when the YVI crosses above a certain threshold, the system flashes to go long the XIV. When the indicator drops down below that threshold, and in this case it did so 3.5 months later, that's a signal to exit our position into cash. All right, in this case, 2 weeks later, it went back long the XIV for about another 4 months or so before exiting into cash. And then 2 weeks later, it went back long the XIV, and then about 3.5 months later, exited into cash. This is from when we rolled out our initial, when we rolled this out, the signals we're using now back in March of last year. These are the signals we got for the period that's displayed. I want to take you now, though. Let's take these signals, go to a price chart of the XIV, and let's just see how well these signals did, okay? There we go. The same signals I showed you are now displayed here on a price chart of the XIV. And so you'll note on the left side, we went long the XIV. The system went long on March 7th at 21.18. It exited June 23rd at 30.05. That's a return of about 40 to 45%, something like that. 2 weeks later, do you see that? It went long on July 7th at 26.52. It's in about the middle of the screen. It exited on November 1st at 35.82. That's a gain of about 30 to 33%. 2 weeks later, it went long the XIV on November 16th at 40.45, exiting to cash late November for 67.40. That was a gain of well in excess of 50%. And so, as you can imagine, if you were to incur a 40% gain here, exit to cash, and then re-enter the market a few weeks later at full strength, where you take your your profits from the previous position and roll it into even more shares the next time around, and you keep investing at full strength every single time, you're going to compound your cash fairly quickly when you have gains of 40% here, 33% there, 50% there. It really begins to add up. And you know what? We went back in time and we back tested this back at 09, coming to the present. And if you had invested $10,000 back in 09 and kept reinvesting at full strength with every signal, your capital would have grown from 09 to present from 10,000 to over 3 million. That's the power of compounding returns. And if you look carefully, though, you'll see that there are periods where the system went flatline there, that it just wasn't in the market. And there's very good reason for that. I'm going to explain it because the market condition during those seasons was just not there to take advantage of the phenomena I'm going to show you. So why does this system work? Why does the VXX trading system work? And there's one term that explains it all, and it's called daily roll. The daily roll. Let's explain this because this is critical to understanding what's going on here. We have to go to the VIX futures to understand the daily roll. And I'm going to take you back to mid-January of this year. We have January through September. The price is on the right side. I want you to note that those are upward in nature. January has a lower price at 12.20. You go out to September, the prices climb up to 19.25. That's an ascending price structure. We call it upward. We're going from low to high. This is what you would have in a bull market typically. Now, why is that? Well, if we're in a bull market, well, let me ask you this. Let's back up. Okay, you don't have to type this in, but just answer this question. Is the stock market more volatile in bullish markets or bearish markets? Just answer to yourself. If you've lived through a bear market, I think you would agree that the market is far more volatile. The stock market is far more volatile in bear markets than it is in bull markets. And that's what the market is saying right here in the VIX futures. If we're in a bull market like we were in mid-January, we have a pretty good, sense that in the immediate months, January and Feb, that the volatility of the market will continue to be fairly low because we expect a bull market to continue for at least a month or two. But you know what? Out 9 months from now, we don't really know if or when a bear market can hit. And if a bear market hits, okay, we know that the volatility of the market will be much greater then. And so the farther out in time we go, the greater chance we have of incurring a bear market. And so that's why out farther in time, the VIX futures will be priced higher and higher farther out in time we go. Now, think about this. If we were in the middle of a bear market, okay, these prices could very well be inverted. Jan could have a $19 price. SEP could be down at 12. Why is that? Well, that would be a downward price structure. And the reason for that is that in the middle of a bear market, what's it like? The daily ranges of the stock market can be quite wide. The gaps can be crazy. Everyone's on pins and needles. And so for the next month or two, we're on pins and needles. But you know what? We all kind of know, the farther out in time we go, eventually the market is going to settle down. All right. Cooler heads will prevail. Those that are seeking to gobble up good bargains are going to sweep in. All right. And they're going to do that. And then the market's going to stabilize and begin its long-term upward ascent. We'll be back to the bull market again. And that's why in a bear market, these prices could very well be completely inverted. That would be a downward price structure. So with that in mind, I want to give credit where credit is due, and let's go and look at where this whole philosophy began, and that is with an options researcher named Larry McMillan. And in his February 23 of 2012, his Option Strategist newsletter, he rolled out this idea. Len Yates in our office read it. We read this article he wrote, and Len in our office really took off and came up with some indicators to tee off on this idea. So let's go to Larry's description because it just elucidates so well the philosophy here. So here we go. Both the VXX and the XIV are constructed in such a way that they actually own, as in the case of the VXX, or are short, as in the case of the XIV, the two VIX nearest month futures. Very important, the two VIX nearest month futures. Each day, part of the position is rolled forward so that a constant 30-day forward position is simulated. Very important. When the term structure slopes upward, like what I just showed you, which it does most of the time because it's in a bull market more often, that daily roll is a debit and is a drag on the performance of the VXX. I'm going to show you an example in just a second. However, since the XIV is the opposite, it is a boon to the XIV. Again, I'll show you an example of that also. Conversely, when the term structure of the VIX futures slopes downward, the daily roll forward for VXX is a credit, allowing it to outperform the VIX. Let me show you an example of this, okay? Go to the left side of the screen. You'll see up at the top left, it says VXX, we're long the front 2 months. Okay? Again, if you own shares of the VXX, your money is being used in a position in the front 2 months that is long the VIX futures. Now, every day, part of the position is rolled so that we're peeling off a little of Jan in this case, adding on a little of Feb. And if you're in the VXX, we have to sell a little bit of Jan, buy a little bit of Feb to keep that 30-day forward position intact. Look at the prices of Jan and Feb. If we're selling a little bit of Jan at 12.20, buying a little bit of Feb at 14.20, that's a net debit. We're selling low and buying high. And that is actually going to have a measurable impact adversely on the price of the VXX. Now, take a look over at the right side of the screen, the XIV. If your money is in the XIV, it is being used to have a short position in the front 2 months of the VIX futures contracts. So every day then, a little bit of Jan has to be peeled off and adding a little bit of Feb. If we're short the front months, we have to buy a little bit of Jan, sell a little bit of Feb to keep that 30-day forward short position intact. Now, if we're buying Jan at a lower price of 12.20, selling Feb at 14.20 and doing that roll, we are doing that for a net credit. And watch this, that can have a measurable impact on the price of the XIV. See that? So that daily roll is going to benefit in this upward price structure. It's going to benefit the XIV. It would hurt the VXX, but benefit the XIV. Now, with that in mind, let's go back to McMillan and let's just let him tee off on this and explain this further. Here we go. So the idea behind the trading system is simple enough. When the VIX futures slope upward steeply enough, like what I just showed you, that's a roaring bull market, and we want to own the XIV. All right, it means we want to be short the VIX because the daily roll forward, the daily roll is beneficial, and because VIX is expected to decline. On the other hand, when the slope is downward, like in a bear market, we want to do the opposite. We want to own the VXX because the market's bearish, VIX is increasing, and the daily roll is beneficial to the VXX. So it's like this, folks. It's like we're in a sailboat, and when that daily roll is really benefiting the XIV strongly enough, we're going to go ahead and buy shares of the XIV. And we're monitoring that daily roll, and as long as it's really good, we're going to stay in that and take that benefit. Now, if the daily roll succumbs, declines and goes flat, we're going to go out of it, and we're just going to wait and see which way that daily roll is going to benefit us. Okay, if it benefits the VXX, we'll go long the VXX instead. It's like we're in a sailboat. Here, it's like we're in a sailboat. We're waiting to see which way that daily roll is going to benefit us, and if it goes one way, we put the sail up and ride it on out. Okay, when it goes flat, we pull the sail in and we wait. Okay, it could go the other way. We could put up a sail another direction and go with the XIV. But that's the nature of what we're doing here. Now, every good sailor has good navigational tools to help them, when they open the sail up and close it and switch and all that fun stuff, like America's Cup, a month ago. Okay, what tools do we use to help us navigate these waters? All right, here is the main component that we're really focused on. It's called the VIX diff. Okay, we're working our way towards understanding this daily roll and showing you this. All right, so the VIX diff is the main component, the main navigational tool that we look at. Here we go. The VIX diff is the difference in the prices of the front 2 months of the VIX futures. Okay, it reflects the difference in the prices of the front 2 months. We take the second month minus the first month. In this case, we have Feb minus Jan, 14.20 minus 12.20 is 2. Okay, now we can't just stick that number in the last column because if we have an inverted set of prices and Jan is higher than Feb, well then the price, it's going to be a negative number, and we cannot have in our last column a negative number because stocks and indexes, they just don't go negative. So what we do is we take the number and we add it to a base 0 of 10. So that way, anything above 10 means that we have a positive VIX diff. Okay, if the price structure is downward in nature, then we're going to have a negative number, and it's going to be something less than 10. It could be in the 8s or 9s. So what we've done at OptionView is we've gone back in time when they began trading VIX futures, and we have built price charts of the VIX diff from then all the way to the present, open, high, low, and close of every day going back to when it started trading futures on the VIX. Pretty cool, huh? And this is unique to OptionView. If you want this data, you have to subscribe to OptionView. We also give the price charts, to our subscribers as well. But take a look at this price chart of the VIX diff. And what we started out with was simply throwing on a 15-day simple moving average. And for a while, this was our main trigger. And what we discovered after a few years of research is that our signals got much better if we applied a moving average and adjusted it for volatility. And that's kind of what we did with the YVI that you see down below. If you look carefully, the shapes of the blue lines are very similar, but they're not precise. The YVI down below has a similar but different shape. That's because we've adjusted it for volatility. And so that's what the YVI is. The indicator we use to make this system go is a 15-day moving average of the VIX diff, proprietarily adjusted for volatility. And here's the trigger points. Right? When the YVI crosses above 0.83, which is that green dash line there, that's when we're long the XIV. If it crosses down below that green dash line, we're in cash. Okay, now look down below, you see that little red dash line? That's the area there where if the line crosses below that red line, we now go long the VXX, that's a value of negative 0.6. We're long the VXX instead, and when it ascends above the red line there, negative 0.6, we're in cash. So we basically have three zones here. Above the green line is we're long the XIV. In between the green and the red line is cash. Below the red line, we're long the VXX. Now those purple bars, that's called the danger indicator, and that's something we provide our subscribers if they want to have something to trade a little more discretionarily. That's a good word. Just some additional data, and we have a great video that explains exactly what that is. Now, this area here, back in 2011, is where the system went long the VXX for a period of several months. Let's go take a look and see how well the system did back when that signal fired. And this fired back in August of 11 on the 5th, 15.5, getting out on the 18th of November at 23.44.5. That was again a gain of well over 50%. And again, when you have 50% here, 40% there, et cetera, you can just have some outstanding returns. So final point here, and that is this. The premise is that we want to be in a position to take advantage of that strong daily roll. How big can that be? Is it really, how consequential is that daily roll? Let me just show you an example real quick. This is from the same day that I took the other data. And this was from January 13th of this year. When the XIV was at 55.23 on this particular day, you can see there that little indicator, and we publish this for our subscribers. It's called the XIV daily roll effect. We calculate how much the XIV is going to be impacted from the act of that daily roll that has to take place. In this case, the daily roll was 36 cents with the XIV at 55.23. How much is that? Okay, let's just calculate that out. When you run the numbers, 36 cents reflects about 0.65%. That's more than 0.5% for just that one day. Now, that's for a calendar day. Okay, you have 30 calendar days in the month. At 0.65% at that pace, you're looking at a gain just from the daily roll of 19.5% for that month. Now, at that pace, is that like the all-time high? Not by any stretch. Daily roll has been much higher than that, a lot. I would say it's in the lower part of the upper range. Okay, it's in the heart of where we want to be when we are acting on the strength of the daily roll. So it's right in there. I just pulled that example out because that was a good day to take a good reading that displayed the characteristics that we showed you here. But this is, just imagine if you're always in the market, only when the daily roll is impacting you in a positive way like this, day by day, week by week, month by month, you can have these kind of outstanding returns. Okay, and we're excited to give you the opportunity to join us in this endeavor. And so where would you go now? Okay, we ask that you get more educated. If this is something you want to think about participating in and applying some of your capital to something longer term, where you're in the market for weeks leading to months at a time in a trading system like this, we have an ebook that you can read. And we would ask that you go to our website, vxxtradingsystem.com. I'll let Jim sign in if I don't know what emails you received about it, but we have an ebook for you. Also, you can register and watch the videos. We have 2 more videos for you to watch, both of them done by Len Yates, our founder and president. He uses animation. He explains clearly the necessity for market volatility and the hedging that goes on the part of big players that then drive the opportunity that we've shown you here today. 2 videos and an ebook, and if you educate yourself and you know what you're getting into and you want to throw some capital towards this, we ask that you go and subscribe. You can just go and to the website, VXX Trading System, hit subscribe. It's $1,200 for the year. And what you get with that are emailed trade alerts and signals, access to the proprietary indicators through both the member section of the website and also within the option view software. And then we give you monthly status emails as well. Okay, now these trade alerts just go out and you can use them, and it's up to you to go and trade them if you want, but you're getting those in the middle of the trading day so that if you choose to, you could certainly have time to do so. I've looked at all the alerts that I've gotten, and indeed they all give me plenty of time to take action in the middle of the day. All right, so you're given at least a few hours to act once you get those alerts sent to you. All right, and finally, I want to show you, this is a screenshot of both in option view, what the quotes display would look like, showing you the various indicators that we give our subscribers, and also on the member section of our website, you would get access to all of these, the futures prices. We have the indicators I showed you, the daily roll effects, the YVI, and a few others as well, danger indicator in addition to that. And if you have any questions, you could always call us and talk to the reps here. They'll be glad to expound further on the trading system. It's 847-816-6610. And that pretty much takes us through the presentation for here today. And again, the next thing to do would be to watch the videos and read the ebook. And Jim just put the little links there. That's awesome. And any other questions, go ahead and fire away, and we'll let Jim or myself could attack these. All right. Yep, Jim put in the announcement. Great. Okay, I don't see any other questions. So if Eric or Josh want to come on and close this up, that'd be fine. I just want to thank everyone for joining us. And again, you have the links there. And if you have questions along the way, that's what we would really prefer, is you can just give us a call after reading the ebook and watching those videos, and that'll give you some great background. Well, I'm going to assume Eric and Josh will close up the room in good time. Just thanks so much for everyone joining us. We really appreciate it. Take care. Have a great rest of the day. Have a great evening. Take care. Bye-bye.